Planning for your child's future, education costs are only going up, and so is the confusion around which plan to choose. SBI Life Smart Scholar Plan claims to offer insurance protection plus investment for your child's goals. But how does it really work? And is it really the right fit for you? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. This is an individual unit-linked non-participating life insurance product. Some of the key features of the policy are: this policy gives you the twin benefit of insurance coverage and market-linked returns in one plan, and you can pay premiums for a limited period, whereas the policy benefits would continue for the entire policy term. And there are inbuilt waiver of premium benefit to ensure a continuance of your policy, an accidental death benefit, an accidental total and permanent disability benefit is an integral part of this policy. And based on your risk tolerance, you have the flexibility to choose from 9 fund options ranging from equities to debt funds. And there are regular loyalty additions to boost your investments as well. These are some of the key features of the policy. There are other benefits like death benefit, maturity benefit, loyalty addition, tax benefits, premium payer waiver benefit, and accidental benefit. And as I have already mentioned, there are 9 fund options, which in this tabular column we have presented on the screen before you. We have categorized all these fund options based on the percentage of allocation each fund option has to asset classes like equity, debt, money market, and also we have categorized it based on the risk profile each fund option has. And as this is a ULIP policy, there are various charges as well presented in this policy which we have to pay as an investor. So these charges are presented on the screen before you for your easy reference, which you can pause and see. So all these charges are extra overhead costs for the investor. So what they do is they will deduct these charges from your premium before investing into the fund options you have opted for. So over a period of time, the initial investment amount is already low. So over a period of time, your returns will be impacted significantly. So this is a drawback that you need to keep in your mind before deciding to invest in this policy. Now, if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now, let us take a look at the advantages and disadvantages of investing in this policy. Let us start with the advantages. There are 9 different fund options to choose from. Loyalty addition are here to boost your fund value. Accident benefits and premium waiver benefit are inbuilt features or riders of the policy. Partial withdrawal is also allowed from the 6th policy here. The dual benefit of an insurance cover and market linked returns, and tax benefits are there under section 80C and section 1010D of the Income Tax Act 1961. And there are disadvantages as well, which, as this is a ULIP product, it does not offer any liquidity during the first 5 years of your contract. So the policyholder will not be able to surrender or withdraw the monies invested in the ULIP policy completely or partially till the end of the policy's 5th year. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where to truly assess whether this policy can give us sustainable returns in the long term, we are going to conduct an IRR analysis, which is to calculate the internal rate of return of this policy based on the benefit illustration given in the policy brochure to help us take an informed decision. So for example purpose, let us assume the parent, who is Mr. Sham, is aged 35 years, has a child who's 5-year-old. So he purchases this policy with a policy term of 20 years and a premium payment term of 20 years. So he pays a premium of 1 lakh rupees annually for a basic sum assured of 10 lakhs. So the fund option he has opted to invest in is 100% equity fund. So in this scenario, we are going to calculate the assume gross return in 2 scenarios. So as this is a ULIP policy and it has market risk because he has opted for a 100% equity fund, we are going to calculate the returns in 2 extremes, like in a worst case scenario and a best case scenario. For this, the worst case scenario assume gross return is 4%, while in the best case scenario it is assumed to be 8%. So these are not guaranteed returns, and these are not the only upper or lower limits you can get from this policy. So these are just assumed returns for example and calculation purposes. The actual returns will depend on various factors, including the future investment performance of the policy. So here, in the 4% scenario, which is the worst case scenario, the fund value is accumulated into 23,43,641 rupees, And the IRR, according to the policy's maturity calculator, works out to be 1.49%, which is lower than a savings bank account interest. In the best case scenario, which is the assumed gross return at 8%, the fund value is accumulated around 37 lakh 7,729 rupees as a maturity benefit, and the IRR works out to be 5.57%. You still can't consider this return as an inflation beating return, which means this policy is not giving us sustainable returns in the long term period to help us achieve the inflated cost of the educational goals of a child. Now, as this policy is not giving us the desirable outcome that we need, let us move on to a comparative analysis where we are going to invest in an alternative strategy where we are going to invest in insurance and investment separately. So, for insurance purpose, we have opted for a pure term insurance policy for a sum assured of 1 crore, but the premium here we are going to pay is just 12,600 rupees compared to the 1 lakh premium we paid for the SBI life policy. So, this is also a policy term of 20 years, which has a similar metrics to the SBI life policy example for a fair comparison. So the balance amount to be invested is 87,400 rupees. So if you are an investor who is not willing to take a lot of risk, you can opt to invest in a debt instrument like PPF, Public Provident Fund. In the term insurance plus PPF combination, the IRR comes around to be 5.96%, which is still slightly higher than the 8% return scenario of 5.57% in the SBI life policy. So in the term insurance plus ELSS combination, which is the post-tax return we are going to calculate, the IRR comes around to be 10.14%, which has accumulated a fund value of 64 lakhs 5,561 rupees. So as you can see from this comparison that the return from the term insurance plus ELSS combination are much higher compared to the SBI Smart Scholar plan. So in the Smart Scholar plan, in case of death of the policyholder during the policy term, the 10 lakh rupees is paid, which will still not be sufficient to meet any expenses for your child's future. Whereas if you separately take a pure term insurance for a sum assured of 1 crore, you will get that amount, which will be highly sufficient for your child's goals in case of your unfortunate absence. Now let us move on to understanding what is the final takeaway from this video. Is investing in the SBI life insurance child plan Smart Scholar plan worth investing or not? So compared to other alternate investments, this policy does not give you an inflation beating return. But still, why do insurance agents try to sell this product to you? Just like many ULIP policies in the bazaar, the plan gives a high agent commission. As simple as that. So if you don't want to take any investment risk, then you can go for risk-free investments such as PPF, RBI bonds, etc. But if you do want to take an investment risk to earn better maturity value, then you can choose an equity mutual fund with the help of a financial planner. As for the insurance policy compared to ULIP, you can choose an individual insurance plan like a pure term insurance policy at a low cost with a high life coverage. So in conclusion, analyzing this policy has made it clear that it's not a one-stop or a one-time investment solution for your child's financial future.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.